In exercise 7-14, we're going to take a look at depreciation expenses when there is a change in an estimate. So let's start out by reading the basic information given to us. We have a donor shop that acquired equipment for $19,000. They use the straight line method and estimate that the residual value is going to be $3,000 after a 4-year service life. And they tell us that at the end of the second year, so they've finished depreciation for the first 2 years, the company estimates that the equipment will have a useful life of 4 additional years for a total service life of 6 years rather than the original 4. At the same time, they changed the residual value to $1,200 from the original $3,000. So let's first write down this basic information. We have the original cost is $19,000. We acquired the asset on 1/1/24. I'm just making up that date so we have dates for our reference. We expect the asset to be useful for 4 years, and $3,000 is the estimated salvage value. This is the original number when we bought the asset, and we're going to use the straight line method. So let's first calculate the depreciation expense for the first 2 years. They've asked us for years 3 to 6, but let's start out with years 1 and 2. Depreciation expense in the straight line method is calculated as the original cost minus salvage value divided by life. So let's write that down. We have 19 minus 3,000 divided by 4 years. That gives us depreciation expense at $4,000 per year. I had the asset for 2 years. So I depreciated it at the rate of $4,000 per year for 2 years. So my accumulated depreciation is $8,000. So I'm done with 2 years of depreciation. So let me just figure this out here in my balance sheet. I have the original cost at 19, accumulated depreciation is 8, leaving me with a book value of $11,000. Now I start my 3rd year, and this is when I make my revision. So let me write this down. So before I make my revisions, my book value is $11,000. That's what I figured that out. Now I'm making my revision effective 1/1/2026. I bought the asset on 1/1/2024, so I had it in 24 and 25. I depreciated it at the rate of $4,000 per year, and now I'm making the change. Now what I'm saying is at this point of time, I expect the asset to be useful for another 4 years. The original had said 4 years. If 2 years were up, then only 2 years were remaining. But now I'm saying, no, I'm going to have it for a total of 4 years. And then I'm also saying the salvage value will not be 3,000. Since I've extended the life, I'm dropping that to 1,200. I'm still using the straight line method. So now when I calculate the depreciation expense, my starting point is $11,000. Remember we said original cost minus salvage value, but now we are going to say 11,000. So 11,000 minus 1,200 divided by 4. So 11,000 is the book value before revision, minus 1,200 is the new salvage value divided by the remaining 4 years. Now gives me depreciation expense of $2,450 per year. So depreciation expense from $4,000 dropped to $2,450 because I'm extending the life of the asset. So I've dropped it to $2,450 because I think I can have the asset for an additional 2 years. So let's just go through the journal entries on the date of acquisition. This is the first journal entry. Equipment debit, cash credit. We paid $19,000 for it. Our depreciation entry, December 31st, 2024, and the same on 2025 is going to be depreciation expense debit, accumulated depreciation credit, and that's $4,000. That's what we had over here. From December 31st, 2026, we're going to have this journal entry 4 times, and this is going to now be for the $2,450. So in the exercise, they just asked us for this journal entry, but we needed to go through this process to arrive at the book value here, that then we can calculate the new depreciation expense. So one of the good things that we have over here is anytime a change is made, the change is effective in the current year and moving forward. So we made the change on January 1, 2026. So the change is effective from January 21, 2026. It does not go back to the past 2 years where we had already done our depreciation expense. It's not retroactive, it's prospective. We move forward and do that. So that should finish this exercise on depreciation. And in the next exercise, we're going to look at some more topics relating to long-term assets.